So good morning. Hope you can hear me clearly. Please confirm that you can hear me clearly, please. Confirm that you can clearly hear me. So thank you for confirming. So welcome back. I think we were having a break of like 2 weeks as a result of the exams. 2 or 3 weeks, I believe. There was a week for that you had been given for revision. Then there was a week for exams, and then there was a week for us to mark. But now you're going to continue. But you should not worry about the 3 weeks that for exams because they have been catered for by extending the semester. So today we are supposed to discuss company accounts. I believe we have the resources with you. We are going to first take the first few minutes and discuss the theory part of it before we can look at the format of a company account. And probably now we look at an example. So remember, just like I've been saying in accounting too, as we observed in manufacturing, the concept, the documentary concept of accounting still remains. The format of the trading profit or loss account and the balance sheet, much of it still remains. We are only adding some sections for each type of account. In manufacturing, we found that we were adding a manufacturing section, a manufacturing account section. Now, what about a company now? What would be the difference in accounts for a company? But first, we can go through that very, very quickly. We are told limited companies come into existence because of the growth in size. Remember the accounts that we did in accounting one, the normal trading profit or account and balance sheet. You are referring to them as accounts of a sole trader. It means that is a business owned by one person. But now, what will happen now when we have those businesses or those companies now with different owners? The some, for example, for example, Safaricom, they can have even thousands of owners or shareholders. So such companies or such businesses are now the ones that you are referring as companies. That's why we are told they come into existence because of the growth in size of business and the need to have many investors in the business. So the difference between a company and just the sole trader or just a simple business is for a company we have so many owners or so many shareholders. So we have two types of companies. One is private companies. If we are told that they have, sorry for that. So you have two types of companies here. So for companies, I think you have observed that most companies they have the word limited at the end. Maybe ABC Limited, name of a company, then limited. So limited is a very important word that differentiates a company from maybe partnership and other sole trader or simple businesses. So we are told that they have the words limited at the end of the name, and being private, they cannot invite the members of the public to invest in their ownership. The issue to do with shares, we are going to discuss them in details in semester 4 when you are going to be discussing business finance. But we are going to discuss, maybe you are going to highlight a few, but there is an issue of buying shares of a company. When you buy shares of a company, you become a shareholder. Being a shareholder means you are part of the owner of that company. So we are told that for private companies, they cannot invite members of the public to invest in their ownership. In short, they cannot invite members of the public to buy shares of that company. Being private means those people who started that company, they cannot invite other people into that company and become shareholders of that company. It is a private business. Then you have public companies, and we are told that they are much larger in size compared to private. And they have the words public limited company at the end of their name, so that is a differentiating words. They can invite members of the public to invest in their ownership, and the companies may be quoted on the stock exchange. So, in public companies, they can invite members of the public to buy shares of that company. And being quoted on stock exchange, again, this is something that we're going to discuss in detail in semester 4 in business finance. It means that your shares can be traded at, in our case, Nairobi Stock Exchange. If you're interested much in business news, after the normal news, you see that there is some information that comes about shares of different companies, share prices of different companies. So those shares of different companies are traded at Nairobi Stock Exchange in our country. So that is the two types of companies. Now at least we can highlight what we mean by share capital of a company. Share capital of a company. So I had to mute all of you so that you can be together. So share capital of a company, we are told the owner's interest in a limited company consists of share capital. So this is what I'm saying. If you buy a share, you buy shares of a company, you become an owner or a shareholder of that company. Now the money that you give the company, because as a result of buying those shares is referred to as a share capital. So share capital is now the money that you give to that company when you buy its shares. But now you can have two types of shares. That's why we are told the share capital is divided into shares, and we are told that the investor will then pay for and be issued with the shares, and therefore they become owners. So share is just a certificate to show that you have bought or you have become an owner of that company because you have done this and this and this. So from you to the business, you give money. From business to you, you get a share or a certificate to show now that you are an owner of that company. And I'm saying now that money that you give to that company is referred to as share capital. But now we have two types of shares. We have the first one, preference share capital. Now, preference share capital is now the money that the company receive when they sell preference shares. So these are things that we're going to discuss in details in semester 4, but you can have what we refer to as preference shares. We have two types of shares, preference shares and ordinary shares. Now, when the company sell preference shares to members of the public, the money that they get is referred to as preference share capital. And mostly, they are given in a percentage. In fact, that as you're going to see in our examples, preference shares have a percentage next to it. It means that percentage is the return that those shareholders are supposed to be given per year. So 10% it means per year, those shareholders are supposed to be given a return of 10% of their investment. So we have some characteristics of preference shares, as we are going to discuss them again in details in semester 4. For example, that preference shares, they do not have voting rights. They cannot vote in annual general meetings of the company. So in short, they don't control the company. They cannot vote in any decision. They cannot sack manager or directors, etc. They don't have any control in the company. Another right is that they have a right to a fine or a fixed dividend. Dividend is now the return that you get as a shareholder, maybe per year or after 6 months, because of investing in that company. You have bought shares of, for example, Equity Bank. How do you benefit? You are given dividends at the end of the year or after 6 months or the period that the company decides when they make a profit. So when the company makes a profit, part of that profit is shared to shareholders as part of dividends. So dividends is now the return shareholders get for their investment in that company. So we are saying that for preference shares, those people who have bought preference shares, they are entitled to a fixed dividend. It means that they must be paid a fixed dividend per year, regardless of the profit made by the business. So even if the company or the business does not make any profit, they need to know where to, they have to make a decision of where they're going to get money to pay these preference shares. Then we have now the second one, ordinary share capital. For ordinary share capital, now it is we are told that they are the most common shares. Now they are referred to as ordinary shares. Now, when the company sell ordinary shares to members of the public, the money that they receive is now the one that is referred to as ordinary share capital. They are the most common because as you are going to see in characteristics or features in semester 4, one of the characteristics is for ordinary shares, they have a right to vote. They can vote in annual general meetings, they can sack directors, they can sack management, they can vote on various decisions taken by management. So in short, they control the business. So I think you have heard of annual general meetings of various companies. Those people who attend those annual general meetings are ordinary shareholders. They are the real owners of the business. But now another differentiating characteristic is they don't have a right to fixed dividends. To be on a preference shares, they have a right to fixed dividends. That is, they must be paid dividends. But for ordinary shares, they are only given dividends when the company makes a profit and has paid for all obligations. So don't worry much about that. We are going to discuss them in details in semester 4. So for ordinary shares, they only get a dividend when the company makes a profit and has paid for all other obligations. So it is not a must for ordinary shareholders to be given dividends. As a company, we only give them dividends when we make a profit and we don't have any other obligation that we have. So we are told that the more the number of ordinary share held, the higher the control. So if you buy more of ordinary shares, it means you have higher control over the business of the company. So those are the two major types of shares, ordinary shares and preference shares. Now let's go to the next discussion, which is now our concern. Now, the format of the company account. What is different from what we already know? Because we know that there must be a profit and loss account, because a company is still a normal business whose objective is to make profit. So we are told the profit and loss of a company is the same as that of a sole trader, but there are additional expenses that are unique to the company. So the profit and loss account, it is very similar to what we have been doing. The sales, less returning ones, less cost of sales, and other incomes, less expenses, all of that is the same. But now we are told we have some unique items, especially expenses that are unique to a company. For example, we have directors' fees, salaries, and other expenses. It is only in a company where we have directors. So the fees, salaries, and other expenses will be a unique expense for a company. Then you have audit fees. I believe DAF student, or I don't know whether all the DAF students are doing auditing this semester. Auditing, we have a person we refer to as an auditor. An auditor is a person, in short or in summary, who checks the books of account whether they have been prepared according to the standards. Remember, accountants are employed by the business. Accountant who is preparing the books of account, who is preparing the profit and loss account, is an employee of that company. And you can imagine that accountant being an employee, it means he or she is controlled by management because they report to management. Accountants report as employees, they report to management. So what if those accountants, in quotes, cook the books of account? It's meaning that the books of account information is not following the standards, or they are hiding something, or maybe they are over-reporting something, overestimating incomes, because maybe management want to show that the company is making a profit, and maybe it is not the truth. So who will come and verify what accountants have done is up to the standards? So that is the work of those people we refer to as auditors. So auditors are those people who come to the company or to the business and they verify that the books of account have been prepared according to the standards, international standards. So they come and verify, we have the evidence of this transaction. So this figure that you have in the books of account, in the trading profit and loss account, where is the evidence? So that is the work of auditor, and they generate some fees. So So please mute your mic. Please mute your mic, please. Those auditors are paid a fee, and that is what we refer to as audit fees, and it is an expense to the business. Then we are told that another expense is amortization. Amortization at this level, we are not going to talk much about it because in a business or in a company we have what we refer to as goodwill. But at this level, what I just want you to understand is amortization is like depreciation. Amortization is just like depreciation. When you depreciate in a current asset, it's very similar to what we refer to as amortization, only that for amortization is for non-tangible or intangible assets, those assets that you cannot be able to touch. Then you have debenture interest. We are going to talk about the debenture down here after our format. Then we are told after that, in addition to the profit and loss account, so in addition to what we already know, the profit and loss account, I don't know who is it to mute his or her mic. Mohammed, can you please mute your mic? Mohammed, can you please mute your mic, or I remove you because I will not be able to unmute you from my end. So the format, we are told in addition to the profit and loss account, in addition to what we already know, the normal trading profit and loss account, we add another section we refer to as appropriation account. Even in partnership, our next topic is partnership. We are going still to come across this section we are referring to as appropriation account. So in addition to what we already know, the profit and loss account up to the net profit or the net loss, we add another section after that. So in short, our title should read trading, profit and loss, and then appropriation account. We are adding another section we are referring to as appropriation account. So the first section up to the net profit is the same. It is similar to what we already know. As you are going to see, only we are adding a very small section we are referring to as appropriation account. So let's see, as you can see the format, the name of the business must be there. Now the title should read trading, profit and loss, and appropriation account. So we are adding another section, appropriation account. Just like in manufacturing, we added manufacturing account section. Now in this section, we are going to add appropriation account section. So you can see the first items are similar to what we already know: sales, less return inwards. To get the net sales, we go to the less cost of sales. Opening stock, purchases, carried inwards, return outwards. We less the closing stock. Then we get the gross profit. We add other incomes. That section is the same. We less expenses, other expenses, and the unique expenses of a company, director salaries, fees, audit fees, debenture interest now. So up to that point, it is very similar to what we already know, adding other incomes and raising expenses. But now, after that, we are used to, normally we are used to, after raising expenses, we are used to calling that value net profit or loss. But now in company, note that we are going to refer to that figure as profit before tax. Instead of referring to it as net profit or loss, we are going to refer to that figure as profit before tax. So after raising expenses, instead of net profit or loss, we refer to it as profit before tax. Then we less taxation, because for a company, they must pay tax, the corporation tax. In Kenya, the tax rate is 30% for resident companies. In semester 4, you are going to do taxation. You are going to understand in details how companies and individuals are taxed. But at this level, just note that after profit before tax, you less tax to get the profit after tax. So after less in tax, you get the profit after tax. Remember, this is the profit that the company has made. If, for example, you have made 10 million, then you less tax, maybe you are supposed to pay tax of 1 million. So what we are left with is a profit after tax of maybe 9 million. Then after that, what usually happens? there is what we refer to as general reserve. We are going to discuss general reserve immediately after this format. But what general reserve means, after now we have paid our tax. Now the money that is left, we take part of that money and put it aside. We are going to note that general reserve is just some money or funds kept aside for future investment. After in future, we will need to buy a motor vehicle. We will need to do some construction. We keep money aside for that purpose. So that's what we refer to as transfer to general reserve. So we are just transferring part of that profit after tax to a fund or a reserve we refer to as general reserve. So to transfer to general reserve, we subtract. Then we less dividends. The issue to do with dividends, again, we're going to discuss it down here. But dividends in the same way, they are returns that are given to shareholders as a result of the investment. Mohammed, I'm going to remove you because now it is becoming too much. So for the dividends, I've said that dividends are the returns that are given by the company to shareholders. And in our discussion, tumesema you can have two types of shares, preference shares and ordinary shares. So we can have dividends given to preference shares, referred to as preference dividend. Now the dividends given to ordinary shares is referred to ordinary dividends. Now, again, those dividends are divided into two: interim and final. We are going to discuss there. We have some notes down there explaining the two. Interim dividends, they are those dividends paid maybe after 6 months. Final proposed, they are those dividends that are paid after the year end. So interim, they are paid at the maybe mostly after 6 months or after 3 months. Then the final, they are those dividends that are paid at the end of the year. So dividends, both interim and final proposed, they are subtracted. That's why you can see they are all in brackets. So kama kuna preference dividend, you subtract. Kama kuna ordinary dividend, you subtract. If you have both, you subtract. Now, remember, we were from profit after tax, then we less transfer to general reserve, then we less those dividends. Then what we get, we refer to it as retained profit for the year. So retained profit for the year is after subtracting general reserve, and then after subtracting all those dividends, we get now the retained profit for the year. Now the section from after the profit before tax, from taxation, that is the appropriation account that we were talking about. That is appropriation account that we are talking about. That is appropriation account that we are talking about. After less in tax, then we less transfer to general reserve, then we less dividends to get the retained profit for the year. After getting the retained profit for the year, that is a profit that was retained. Remember, if you are not in what we are doing, after we get the profit, it's like we are subdividing that profit into various functions. First, we pay tax. Second, we transfer some funds to general reserve. Third, we pay shareholders dividends. Now, after doing all that, what remains is now what we refer to as retained profit. It is now the profit that remains after paying tax, after transferring to general reserve, and after paying dividends. Now, that's retained profit that remains for the year. Remember, this is not the first year that we are doing business as a company. We have the previous year. Now, the retained profit year previous year is now the one that we are referring to as retained profit brought forward, brought down. This is now the profit, the retained profit from previous year. Now we add it to the retained profit for this year to get retained profit carried down. That is CD. So retained profit for the year, we add the retained profit year previous year, that is the retained profit brought forward, to get now the retained profit carried down. And that is the end of our trading, profit and loss account, and appropriation account. So the section from taxation up to the retained profit carried down is the only new section in company account. It is the only section we are referring to as appropriation account that we are adding after getting the profit. If you have a question on that format, the next 2 or so minutes, can you ask any clarification that is needed in that format of profit or loss account and appropriation account? On dividends, Miriam, I think in our note down there, I'm going to repeat it again. So just wait until we reach that section. Don't worry about that. Yes, you'll be given Christine. Retained profit for the previous year will be given for you to add. That one will always be given. Retained profit brought forward will always be given Christine. So Sharon, I'm repeating again that the retained profit brought forward is the retained profit of the previous year, and that retained profit brought forward you will always be given, and you add that retained profit brought forward to the retained profit for the year to get retained profit carried down, Patricia. So after getting that profit for the year, you add the retained profit brought forward that will always be given to get now the retained profit carried down. So retained profit carried down is the retained profit for the year plus the retained profit brought forward. Yes, that will always be specified, Veronica. We are going to see how preference dividend is calculated and how ordinary dividend is calculated. They always give that information separately. There should be no confusion. Any other question? So transfer of general reserve, I said that general reserve is just a funds kept aside, mostly for investment, for future investment. And in future, we need to make some investment, maybe even buy some assets or do some construction. Now, instead of now, when we reach at that time, instead of now start again asking ourselves where we are going to get funds from, we have been keeping aside some funds for such investment. So general reserve is just funds kept aside for future investment. So we transfer of the profit that we make, at least we make sure every year we transfer part of that profit to the general reserve fund. Any other question, please, so that we can continue? So let's continue. In case of a question, you can ask anytime. So wait a minute, I share the remaining section. So that is the section of balance sheet I'm sharing. So we have now discussed, or we have seen the format of the profit and appropriation account. What about now the balance sheet? We are told balance sheet format is similar to that of a sole trader, but the foreign section is different. So again, balance sheet is very similar to what we are used to. Non-current assets.
Oh, Dewi sih. Ah, okay, no problem. Kita. Full traffic. Eh, kita. Jadi kan dari kita.
Kota mendapatkan Rita.
Boleh dinaik. Dari ibu. Itu melawat alam apa?
Sorry for that. Power is lost in my area and itself switches off. So I've been forced to use my phone. we are going to continue our discussion. Mohammed, you are really disturbing our session. I don't know what's the problem. So let me see again that section. If it will not be possible, we do an example on the trading, but let me see whether it will be possible to share. Using So can you please confirm that you can be able to see the format on your end and it is clear? Please confirm. Confirm that you can be able to see it from your end. So I was saying for the balance sheet, thank you for confirming. For the balance sheet, the format is the same, but in that section of finance, right, we are used to having capital, but now you're not. Company, we have share capitals. So in this section, what do we have? We have now ordinary share down there, the valuation reserve. We are going to discuss the valuation reserve down there. We have another one you refer to as capital redemption reserve. Again, we are going to discuss it down there. Then you have now the general reserve. You can see all those are reserves. General reserve, I've said general reserves is just now money kept aside for future investment, but again, it is explained down there. Now, then the retained profit carried down. You see the retained profit that we got carried down, that we got in our trading profit and loss account and appropriation account. The retained profit carried down is now the one that we take to balance sheet. The retained profit carried down is the one that we take to balance sheet. And sometimes, in some questions, they may be referred to as profit and loss. So when you see profit and loss balance or profit and loss account balance, it is the same as the retained profit that we are talking about. So the retained profit carried down, the one that we got in our trading profit and appropriation account, we take it to the balance sheet. Now, then the next thing that we know is non-current liabilities. We are used to having loan as an item under non-current liabilities, but now for companies, we can have debentures. We are going to discuss the debentures down there, debentures and now other loans. Your debenture is just like a type of loan, only that it is unique for a company. We can have debenture and down the loan. So that is the only difference. It comes to balance sheet of a company compared to the balance sheet of other items that are unique for in a balance sheet of a company. Let's now discuss some of those specific items that are there, at least they're explained down there. We had the director salaries, fees, and other expenses in relation to the directors. I think I said that. We had audit fees, and I said audit fees are the fees that are paid to auditors. who come and audit the books of account. We have the debenture interest. So the debenture interest is like interest on loan. So nimesema debenture is like a type of loan. Only that mostly we use the word debenture when it comes to companies. So we are told loans taken up by companies are called debentures. The interest that is paid on these loans, of course, is an expense, and unpaid amount are shown as current liability in the business. Just like in case you have not paid that interest, it will be a current liability. And then we have said in our balance sheet up there, debenture is an current liability. So debenture, just note that debenture is just like a loan. So kama kuna interest on debenture, interest on that debenture or loan is an expense to the business. Then the dividends, I have tried to explain the issue to do with the dividends, and we have a share of profit made by the company, and this is because the shareholders do not make drawings for the company. So remember in our past balance sheet, we used to have an item drawings, but now in a company you cannot have drawings because shareholders cannot withdraw money from the business. So what we have is dividends. And we are told a company may pay dividends in 2 stages during the course of the financial period. So just like I was saying, you can have 2 types of dividends. Interim dividends, mostly they are paid partly, mostly after 6 months of the financial period. Then final proposed, it is paid after the year end or after the completion to the final account. So those are the 2 types of dividends, interim and final proposed. And if a company pays in these 2 stages, then the dividend section of the profit and loss account preparation should disclose interim paid and final proposed. That is what is in our format. So kama walilipa interim dividend and then we come now pay final proposed dividend, for appropriation account you must show them separately. You must show interim dividends paid separately from now the final proposed dividends. Then after that, we have now what we refer to as capital reserves. So remember, you need to understand what I mean by capital reserves and the examples. For capital reserves, anything that we refer to as capital reserves, it cannot be distributed or paid out to shareholders. That's why we are told amounts reflected in the capital reserves cannot be paid out or distributed to shareholders. That is now the differentiating definition of a capital reserve. The reserves are just funds kept aside. And we are saying that for capital reserves, those reserves cannot be paid or distributed to shareholders. There is no way to toa pesa from those reserves to leave the shareholders as dividends. No. Capital reserves, we can never do that. And they include what and what and what? Share premium. So we have seen share premium up there. What is a share premium? So remember I said about the issue of selling shares of a company. When a company sells shares to the members of the public, there is a price that those shares are sold at. For example, you find that now when Safaricom was issuing shares for the first time, one share of Safaricom was costing 5 bob. We refer to that as nominal price or par value or face value. So that original price, the company can decide to sell that share at a higher price. So the nominal price or the par value or a share of Safaricom, for example, was 5 bob. Then the company decides to sell that share at 6 bob. The extra 1 bob, is now what we refer to as a share premium. That's why we are told it arises when a company issues shares at a price that is more than the par value. So there's a lot of mathematics that are done for us to get the par value. Of a company. We have a stock exchange we are going to discuss in finance. We have an authority that is referred to as capital market authority. So there is a lot of mathematics that are done when we are calculating the par value of a share of a company. Now, when that par value is, for example, and then the company decides to sell the share at 6 bob, the extra 1 bob is now what we refer to as a share premium. So share premium, just note it is money that arises when a company sells shares at a price that is higher than the par value. Then the next one we have is revaluation of reserve. So again, we have seen revaluation of reserve up there at the finance file. And revaluation reserve Sometimes, for example, when it comes to land, land as an asset of a company, land increases in value. You find that maybe this year, the value of our land was 2 million. Next year, it may be 2.5 million. The value will have increased. Now, the increase, that gain in value of that land, that 500 is now what goes to the valuation reserve. So the valuation reserve, we are told, it is any gain made on the valuation of non-current assets, especially for land and buildings. So when we value upwards, for example, land, last year equal 2 million, this year is 2.5 million. That extra, that gain of 500,000 is what goes to the valuation reserve. Then the next one we have capital redemption reserve. We have seen it up there. And we are told that a reserve created after redemption or purchase of preference shares. You are going to note, as you are going to discuss in details about shares in finance, preference shares can be bought back by the business. A company can buy back its preference shares. Walikuwa wameuza shares to the members of the public, they can buy them back. Now, money kept aside to buy those shares is what we refer to as capital redemption reserve. Money kept aside in case the company wants to buy back shares in future, they use that money. That's why we are told a reserve created after redemption or purchase of preferred shares without issuing new shares. So remember, in an exam situation, they can request you to explain the three types of capital reserves, their meaning. So that's why you need to understand those at least, and you can be able to define them. Now the next one is revenue reserves. So remember, you have seen we have capital reserves. Now we have revenue reserves. Capital reserves, to be honest, there are those three types: share premium, evaluation reserve, and a capital redemption reserve. Now, what about revenue reserves? And remember, again, I'm repeating, capital reserves, to be honest, they cannot be paid out to shareholders. Now, what about revenue reserves? We are told these can be distributed. So revenue reserves can be paid out. They can be distributed to shareholders. They are different from capital reserves, and they include what and what? Retained profit, either retained profit to the owner, the retained profit carried down, or the profit or loss. We said retained profit can also be referred to as profit or loss account. So that retained profit is one of the example of revenue reserve, and the next one is general reserve. General reserve, again, it is something that can be distributed to shareholders. And we are told transfers are made from the profits to the general reserves to provide for expansion or purchase of non-current assets. That is what I was saying about general reserve. It is money kept aside for future investments, especially buying more assets. So that is general reserve. So the two types of revenue reserves, retained profit and the general reserves. And for the revenue reserves, they can be distributed to shareholders. So then the next one is debenture loans. So I've said that a debenture is just like a loan, only that mostly we use the word debenture when it comes to companies. And we are told that the term debenture is used when a limited company receives money on loan and certificates called debenture certificates are issued to the lender. So it's just like a normal loan, only that now in this case, when the company receives a loan, they give a debenture certificate to the lender of that loan. And they are also called loan stock or loan capital. And we have said in our discussion up there, debenture interest has to be paid, and it is an expense. And sometimes, although we are not going to discuss this in details, again, this is in finance in details, we can have different types of debentures. They are redeemable. Redeemable are those that can be bought back. Irredeemable, there are those that cannot be bought back. That's why we are told irredeemable is repayable at or by a particular date, and irredeemable is repayable when the company is officially terminated. Irredeemable unless the company winds up, it is liquidated. That's when you can return that debenture. So then the next thing that you need to understand, the next three discussion: bonus shares, scrip issue, and rights issue. They can tell you to differentiate between among the three. Bonus shares, scrip, and the rights issue. So what is a bonus share? So bonus shares, they are shares that are issued to existing shareholders free of charge. So bonus shares, what happens? Remember, we said shareholders are supposed to be given dividends per year when the company makes profit. Now a company may decide, instead of giving these people dividends, why can't we give them additional shares? Instead of giving them dividends in form of cash, why can't we give them additional shares free of charge? So that's why we are told they are paid out from either the share premium, balance of retained profit of the general reserves. So full stop, but in short, just note, these are shares that are issued to existing shareholders free of charge instead of giving those people cash dividends. Instead to Alipe Pesa, to Abia, we are not going to pay you money in form of cash, but we are going to give you more shares, meaning they increase the control over those shareholders in that company. What about a scrip issue? We are told that a scrip issue is similar to a bonus issue. But now the difference is the shareholder is given an option. Do you want additional shares or do you want cash dividends? So that is the difference between a scrip and a bonus. Bonus, what you call a free shares. But for a scrip issue, a shareholder is given an option. Do you need extra shares or do you need cash dividends? That's why we are told it is similar to a bonus issue, only that a scrip issue gives the shareholder the choice of receiving cash dividends. You can add that. Maybe I think that section was left. It gives the shareholder the choice of receiving cash dividends or bonus shares. It gives the shareholder receiving cash dividends or bonus shares. So that's the shareholder. Next one is a right issue. Now, a right issue, we are told that it is an option on the part of the shareholder given by the company to existing shareholders. So for a right issue, remember bonus issue to be honest, the free shares. They are given free extra shares. Now, for a right issue, we tell our shareholders we are selling shares to the members of the public. But because you people are already our shareholders, we are going to give you an offer. You buy those shares at a price lower than the market price. So if the market price is 30 Kenyan shillings per share, we give an option to our existing shareholders and tell them you can buy our shares at a price lower, maybe 25 per share. So it is an option that is given to existing shareholders to buy shares at a lower price than the market price. That's why we are told there it is an option on the part of the shareholder given by the company to existing shareholders at a price lower than the market price. So these shares are not for free, they are not bonus shares. It is an option given by the company to shareholders, informing them you can buy shares at a lower price than the market price. But now the shareholders has some options, even when they are given that option of buying shares at a lower price, they can decide what. We are told it involves selling ordinary shares to existing shareholders of the company on a pro rata basis. So forget about that. We are told when the rights are issued, the shareholders have two options. Not two options, they should be three. So can you change that? The shareholders have three options. So when you're given by that, by the company the option of buying shares at a lower price, you can do the following. One, you buy the shares and you exercise that right. You buy the shares at the lower price. That is one option you can do as a shareholder. You take the offer and you buy the shares. Two, you sell the rights in the market. Selling the rights in the market means when you are a shareholder, you don't want to buy more shares. And instead of this chance, hypothetical evil, you sell that right to another person outside. You tell another person outside, there is an offer I'm given here, but I don't want to buy those shares. Can you come and buy? If you're going to make a profit from that, you make a profit. Then that option is you ignore. You don't want to buy and you don't want to sell. You just ignore the rights. So a right issue therefore gives the shareholder the right, but not an obligation to buy. So it is a right. It's not a must to buy as a shareholder. It's just a right you can buy, you can ignore, or you can sell. That is what those, I think those notes explain some of the items that were new in our format above. Any question, please? Any question? I don't know why you are not getting me, Christine. Per value here is the original price of a share. It is also referred to as face value and nominal value, but it is the original price of a share. We are not supposed to discuss much details about those prices, but just note that per value is the nominal value or the face value or the original price of a share. And it is calculated using so many, a lot of formulas and factors that are considered before we can come up with a per value of a share of a company. Just note at this level, per value is the original price of the share. Veronica, dividends, I was saying the cash dividends, that was at the bonus issue. Scrip issue is whereby and shareholder is given an option to either take the free bonus shares or they take cash dividends. Cash dividends ni kumaanisha how shareholders wapewe cash, wapewe pesa instead of give them bonus shares, instead of giving them extra shares, we give them dividends in the form of cash. Wapewe pesa watumia kwa M-Pesa or kwa in the account or whatever. Mary, I don't know the problem because I believe others are here can hear me clearly. Irali kita pro rata basis is like a first come first serve basis because you can have so many shareholders in that company. Even if we are giving extra shares to those shareholders, they may not be enough for all those shareholders. So it is like a first come first serve basis, and depending with the control that shareholders have in that company. We may decide that those shareholders who have at least a significant control of the company, we first give them those extra shares. So here the product basis is like using an order, first come first serve basis, or maybe according to the control that shareholder have in that business. Any other question, please? So I've said that theory is very important. The theory is very important. You need to understand it. At least they can request you to explain the two types of reserves: capital reserves, you have revenue reserves. They can tell you to explain the three types of capital reserves. You have seen them: the share premium, capital redemption reserve, and you have the operation reserves. They can request you to explain the two types of revenue reserves. You have the insane profit and you have the general reserve. They can tell you to differentiate between bonus, shares, scrip issue, and rights issue. So at least try to understand those items even before you can go to the format of the company account. So if there is no question, our leaders will look at an example. I hope you have that example with you, but let me try to share from my end. I hope you can see that question, please. Can you see the question? Can you confirm? If at least the question you could see clear, at least you can see the values. At least you can be able to see the values. So I'm using my phone, so you're going to bear with not clear when I'm sharing. So thank you for confirming if it is clear. I'm going to concentrate only maybe on profit and loss account first before, and maybe balance sheet you can even do it in street. There's no problem. So you're told that just before you launch yourself into the question that for us, remember that everything you have learned, that is, that was there purposely to remind you that everything that you have learned in accounting 1 and so far in accounting 2 is the same. Double entry bookkeeping, presentation, the name of the business, the title, the adjustment that you have been doing, the working that you have been doing, the depreciation, the approval, the payment, it is the same. It is same. We are told that you have learned about the entry bookkeeping and the presentation of year-end account is varied in the context of companies, only to the point we have added in this session. So the only point that we are adding, the appropriation account section and the finance by section, and those new items that we have seen that are unique to a company. Those are the only items that we are adding when it comes to a company. But the rest of information, double entry must be there. Adjustment to account must be there. Depreciation, accruals, repayment, everything is very much similar. So we are told that the following is a balance of Transit Limited as at that 1st March 2018. Now you can see we are given ordinary share capital, issued share capital, ordinary share capital of 42,000. Do not concentrate so much on the values. Utapata kuna moja unapata ina cost 500. Purposely I use those values to make our workings and our calculations easier. So just understand those values are there to make our work easier, because in most cases those values, for example, of ordinary share capital are in millions, and in some other companies in billions. But for us to make our calculations easier and for our understanding, I use at least values that are a bit easier for us to use. So ordinary share capital or issued share capital for 2,000. Then you have leasehold properties. Leasehold is just another name, another word that you can use for the plant, for the and current assets. So especially land buildings, leasehold properties at cost, they are worth 75,000. Motor vans at cost, motor vans they are worth 400. Then provision for depreciation, I think we have seen before, provision for depreciation on motor vans we have for 60. Administration expenses 7650, distribution expenses, all those are expenses. Stock as at that 1st March 2017. Remember, our year is ending that 1st March 2018. So stock here, that 1st March 2017, that is the opening stock. That is opening stock at the beginning of the year. Then you have purchases given there, sales, directors and remuneration, that is an expense. Rent receivable. Rent receivable is an income. Rent receivable, it means most likely this company has some residential houses and they receive rent maybe annually or per month. So rent receivable is an income to that company. Then investment at cost. Those are investments. Investments, we refer to them as investments in come around maybe the company has invested in another company. They have bought shares. That is an investment. Investment is an intangible asset. As you're going to see in balance sheet, investments in Abutaga immediately after the non-current assets. Before you go to the current assets, we add those intangible assets like investment. Then you have investment income. Investment income is a normal income, so it's either for profit or loss account and other incomes. 7% debentures. So debentures in December is like a loan, and when you see 7%, it means ile interest unafaa kulipa ni 7% of the total amount of the debentures. So 7% is the interest that you're supposed to pay on those debentures. Then you add down there, we have the debenture interest that was paid that year. Then you have the bank interest, all those are expenses. Bank overdraft, you know, bank overdraft is a current liability. Debtors and creditors. Debtors and creditors is because mepa pamoja. The figure that is on the debit side, your debtors. The figure that is on the credit side, your creditors. So So debtors and creditors, the figure that is on the debit, your debtors, the figure that is on the credit, your creditors. Then interim dividend paid, I think we have seen that in our discussion that we can have dividend paid after 6 months, the interim dividend, and we are not there in our case, the interim dividend paid is given there. Then the retained profit goes down brought forward. In your December, you always begin the retained profit last year. You always begin. That's why it is retained profit brought down for that first March 2017. Then additional information. Depreciation of motor vans has been and is to be provided at the rate of 20.83% per annum cost. So you know about the depreciation on motor vans. We are supposed to calculate depreciation on using that rate on cost. Then the estimated tax. So the estimated tax that you're supposed to pay that year is given there. Then we are told that it is proposed to pay a final dividend. So this is a final proposed dividend. Final proposed dividend, 10%. Of sorry. As usual, you know that we start with the workings. We always start with the workings. So workings mostly is in additional information. And in additional information number one, I think that is clear. We need to calculate depreciation. And we are told to calculate depreciation on a motor vehicle. On motor vans, we are told we use the rate of 20.8.3%. So hope you have your pen, a calculator, and a book there. We are now doing the calculations. We are doing the workings, and you are in working number one. The precision of motor vans is 20.83% of the cost of motor vans. And what is the cost of motor vans? If you check up there, motor vans at cost was 2,400. So 20.83 over 2,400 is how much? Use your calculator, please. Someone to tell me how much is the depreciation. So we are calculating depreciation of motor vehicles, motor vans, 20.83% of 2,400. So 499.92. Please allow me without of that to 500 to make our work easier. So allow that to 500. So our depreciation is 500 for motor vehicles. Our depreciation is 500 for motor vehicles. So that is working number one. We are through with it. Now let's go to working number two. Working number two is clear. We just need to note that in working number two, tax is as given there. So you just need to note that we have tax of 12,700. Tax of 12,700. As simple as that. Then we go to working number three. Working number three, it is proposed to pay a final dividend. So this is what I was saying. Final proposed dividend. Working number three. For proposed dividend. Final, we are told it is 10. 10%. So you're supposed to take have share capital. Up there, the first information, because maybe your issued share capital is worth 42,000. So when you are calculating final proposed dividend, you take the rate, that is 10% in our case, multiplied by that 42,000, the total value of the shares. So that is how you calculate the final proposed capital. Dividend to be 10% of the 42,000. That would be how much? $4,200. That will be the final proposed dividends. 4,200. As simple as that. So you take the rate multiplied by the total value of the share capital given in your trial balance. Then the last additional information you just need to note, you have a closing stock of 16,700. As simple as that. Closing stock of 16,700. So those are the four additional information workings. Always remember, I said that even before you go to the profit and loss account, always start with the workings, because in most cases those workings affect your trading profit and loss account and the balance sheet. Now after the workings, now it is time to go to the income statement, the profit and loss account. And now I need to see how far you can go. I need to see how far you can go. Because we know we started sales. Kama kuna return inwards, we just return inwards. Kama haiko, you go to the cost of sales. Cost of sales, tuko na opening stock, tuko na purchases. Kama kuna carriage inwards, you add carriage inwards. Kama kuna return outwards, you raise return outwards. You less closing stock, you add a gross profit, you add other incomes. Add other incomes in our case, tumesema kuna rent receivable, hiyo ni income, na kuna investment income, that is income. Then again, you less expenses after that. So I need you first to do up to the gross profit. I need you first to do up to the gross profit and give me the total or give me the value for gross profit and see whether you people have been following what you have been doing. So the first section of the gross profit is the same, the way that we do it. Sales, less cost of sales, to get the gross profit. Can you be doing that section? Hoping Steve itakuwa imerudi because even my phone is giving me a warning here. So can you do up to the gross profit, and at least you can give me the figure for gross profit, please. I'm waiting.
Serial.